Welcome to today's Explainer. We're stepping right into the shoes of a mutual fund representative today. Think of this as your diploma-level masterclass. We're going to break down the mechanics of mutual funds, navigate the strict Canadian regulatory landscape, and then apply all of this theory to real-life scenarios, like how Canadian small business owners actually manage their wealth.
So, here is our agenda for today. 1. Mutual funds explained. 2. Types of mutual funds. 3. The representative's role. 4. Regulation and compliance. And 5. Practical client portfolios. Let's jump right in.
Section 1. Mutual Funds Explained. The Basics of Collective Investing. Okay, take a look at Figure 1. We define a mutual fund here as a professionally managed collective investment scheme. But honestly, think of it like a giant financial carpool. Instead of driving alone, trying to research, buy, and manage dozens of individual stocks or bonds all by yourself, you and a bunch of other investors pool your money together. You hand the keys over to a qualified fund manager who navigates the markets for you. It's a fantastic way for everyday investors to get a broadly diversified portfolio that they probably couldn't afford or, frankly, wouldn't want to manage on their own.
Now, if you want to buy a seat in that carpool, how do we price it? Well, we use something called net asset value, or NAV, which you can see right here in Figure 2. It's a simple, elegant formula. You take the fund's total assets, subtract any liabilities, and just divide that by the number of outstanding units. That per unit price gives everyone total transparency into exactly what their slice of the pie is worth on any given day.
But, as we all know, there is absolutely no free lunch in finance. Looking at Figure 3, we can see the advantages and disadvantages side by side. Yes, these funds offer incredible diversification, professional management, and they're super accessible. But you do have to pay fees for that professional management. Plus, there are no guaranteed returns. You are still exposed to market risk. It's always a balancing act, and understanding this trade-off is really step 1 in financial literacy.
Section 2. Types of mutual funds. Categorizing investment objectives.
Not all funds are created equal. In Figure 4, we've laid out the 6 core types of mutual funds, and they all serve totally different goals. You've got equity funds for high growth and high risk, bond funds for steady, predictable income, money market funds for keeping your cash safe and liquid in the short term, balanced funds, which are exactly what they sound like, a nice mix of stocks and bonds. Then there are index funds that just passively track a market to keep your fees low, and sector funds that focus on one specific industry for potentially huge rewards, but again, with a lot of risk attached.
No matter which of those funds you choose, we need a universal scorecard to see how we're doing, right? That is where Figure 5 comes in, return on investment, or ROI. You just subtract your beginning value from your ending value, divide it by the beginning value, and multiply by 100. It tells you exactly how well your investment is performing as a percentage. It's the ultimate reality check for any fund.
Section 3. The representative's role. Guiding the investor journey.
So who's actually helping you navigate all of this? Check out Figure 6. A mutual fund dealer isn't just someone trying to sell you a product. They are a registered, licensed professional legally authorized to provide advice. They act as the vital bridge between complex mutual fund companies and everyday folks. They've passed rigorous exams, and they are bound by strict ethical standards to give you advice that actually fits your life.
And how do they figure out what fits? Well, first, they look at your risk tolerance, defined here in Figure 7. This is a big one. It's the level of uncertainty or potential financial loss you can actually stomach without, panic selling. A good rep assesses your age, your income, and quite frankly, your emotional comfort level. They want to make sure you aren't thrown into an aggressive equity fund if a 5% market dip is going to keep you up at night.
Right alongside risk is your time horizon, shown in Figure 8. This is just your timeline. Think about it. A small business owner saving up for a down payment on a new commercial space next year has a really short time horizon. They need safety. But if that same owner is saving for a retirement that's 30 years away, that's a long time horizon. They can afford to ride out the market's roller coaster to capture that long-term growth.
When you put it all together, you get the client advisory process, mapped out in Figure 9. It is a 5-step journey. You start with onboarding and collecting information, move into profiling the client's risk, and then make a tailored recommendation with complete transparency about fees, of course. Step 4 is implementing the portfolio. But the job doesn't end there. Step 5 is ongoing monitoring and review, because life changes, businesses pivot, and your strategy needs to adapt with you.
Section 4. Regulation and compliance. Protecting the investor.
Now, representatives in Canada don't just operate in the Wild West. Look at Figure 10.
They work under a rigorous, multi-layered regulatory framework. We're talking oversight from the Canadian Investment Regulatory Organization, the Canadian Securities Administrators, and provincial regulators. These watchdogs are there to ensure absolute transparency and to protect you, the investor, at all times. The absolute cornerstone of all that compliance is the Know Your Client rule, or KYC, highlighted in Figure 11. Let me be clear, this is not a suggestion, it is a legal obligation. Before a rep can suggest even a single fund, they are legally bound to fully understand your financial position, your goals, and your risk profile. This also ties into anti-money laundering laws, which keeps the whole financial system secure.
Section 5. Practical Client Portfolios. Applying the theory.
Okay, let's put our representative hats on and look at Figure 12. Here is example 1, a 28-year-old tech startup founder in Toronto. Her goal? Long-term wealth creation. Her risk tolerance? High, because she's decades away from retirement. So, following our process, the suitable recommendation is heavily weighted toward equity funds. She has the time horizon to absorb the bumps in the market in exchange for maximum growth.
On the flip side, look at Figure 13. Example 2 is a 60-year-old owner of a family-run bakery in Montreal who's getting ready to retire. His main goal is capital preservation. He wants to protect the wealth he's already built from his business. His time horizon is short, and he simply cannot risk a market crash wiping out his nest egg right before he stops working. So the right move here shifts to bond funds, steady income, low volatility.
And finally, Figure 14 gives us a great middle ground. Example 3 is a 40-year-old independent contractor in Calgary. She wants a mix of growth and stability for a corporate surplus account. She's got plenty of working years ahead, but definitely wants some downside protection. The ideal recommendation? Balanced funds. It is the perfect hybrid approach, automatically mixing stocks and bonds to match her moderate profile.
So as we wrap up today's explainer, I want you to take a look at Figure 15 and really reflect on your own financial picture. A mutual fund representative's job is to ask the hard questions. So I'll ask you, based on your age, your business goals, and your true comfort level with losing money during a bad month, what is your actual time horizon? Are your current investments truly suitable for where you are in life right now? Give that some thought. Thanks so much for joining me today, and keep exploring.